It is Monday evening, January 26th, 2026. The London market just closed. And if you weren't watching silver today, you missed one of the most significant single-day moves in precious metals history. Spot silver didn't just climb, it exploded, surging past 112 per ounce and setting a new all-time record that has Wall Street analysts scrambling to update their models. Let me give you the exact numbers because precision matters when we're talking about moves of this magnitude. At the peak of today's session, silver touched 112.18 per ounce. That's according to Reuters data captured at 10:13 a.m. Eastern Time. By the London close, it was trading near 111.70, representing a gain of roughly 8.5% in a single trading day. 8.5% in one day. On the world's second most traded precious metal. This isn't normal price discovery. This is a market sending a message that the mainstream financial media either can't decode or won't acknowledge. Welcome back to Mr. Asian Guy. If you're new here, this is where we cut through the noise and to show you what's actually happening in precious metals markets while everyone else is distracted by headlines that don't matter. And what happened today matters more than almost anything you'll read about this week. So if you want to understand why silver just did what it did and where it's going next, make sure you're subscribed with notifications turned on. Because the next 48 hours could define your financial positioning for the rest of 2026. Let me take you inside what actually happened today. Because the surface level coverage you'll see on financial television tonight will miss the most important details. Silver opened the Asian session already showing strength from Friday's momentum. By the time European traders arrived at their desks, the metal was pushing toward $108. That alone would have been notable. But then something changed. The buying intensified in a way that caught even experienced traders off guard. By 0656 GMT, spot silver had already surged 4.8% to $107.90. It hit an earlier peak of 109.44 before most American investors had finished their morning coffee. And then, as the U.S. session opened, the real fireworks began. The metal pushed through $110, then $111, then touched $112.18 before settling into the $111.70 range for the London close. The rally immediately spread to what traders call silver stocks. These are the miners and funds that hold physical bars rather than paper contracts. They attract a different category of buyer. People who don't want futures exposure, people who want real assets. iShares, Silver Trust climbed 7.8% today. ABRDN, physical silver shares, matched that gain at 7.8%. Hecla Mining rose around 4%. Kerr Mining gained approximately 4%. The entire silver ecosystem moved together in a coordinated surge that signals broad-based institutional participation, not just speculative trading. I want to pause here because this is the kind of analysis that takes time to compile and verify. If you appreciate this level of detail, hit that like button right now. It takes 1 second. It tells the algorithm that this content matters, and it helps other investors find this channel before the next major move happens. Now let's talk about why this happened today, because the price action alone doesn't explain anything. You need to understand the forces that drove silver to record highs on this specific Monday in January. Kyle Rada is a senior market analyst at Capital. Come. He attributed today's spike to what he called a crisis of confidence in U.S. assets. Those are his exact words. A crisis of confidence. He specifically pointed to what he described as erratic moves from the Trump administration as the catalyst. Let me translate what that means in practical terms. When investors lose confidence in the stability of U.S. policy, they seek alternatives. They move capital out of dollar-denominated assets and into things that governments cannot manipulate or devalue. Gold is the traditional destination, but silver, which moves faster than gold in both directions, becomes the high beta expression of that flight to safety. Adrian Ash of Bullion Vault put it even more bluntly. When asked about the main drivers behind precious metals this year, his answer was simple. Trump and Trump. That's not my characterization. That's a direct quote from one of the most respected voices in the physical bullion industry. Now I want to be clear about something. This channel doesn't do partisan politics. I don't care which party is in power. What I care about is understanding how policy decisions affect markets and positioning accordingly. And right now, the market is telling us that policy uncertainty is driving capital into hard assets at an accelerating rate. The dollar slipped ahead of this week's Federal Reserve meeting. That's the other half of the equation. When the dollar weakens, commodities priced in dollars become cheaper for international buyers. That increases demand precisely when supply is already constrained. It's a double catalyst that amplifies price moves beyond what either factor would cause in isolation. Quick question for the comments. Were you positioned for today's move? Did you see this coming based on the setup from Friday? Or were you caught off guard like most retail investors? Let me know below. I want to understand how this community is reading these markets. Let's talk about what's happening in China, because that's where the real signal is hiding. Giovanni Starnovo is a UBS analyst who watches precious metals closely. He noted today that Chinese silver prices are trading at a notable premium to London's. That premium suggests momentum could push prices even higher in the coming sessions. Think about what that premium means mechanically. When Shanghai is willing to pay more than London for the same metal, it creates an arbitrage incentive. Physical silver flows toward the higher price. That drains inventory from Western vaults. And when vaults drain, paper contracts become harder to settle with actual metal. We've been tracking the Shanghai stockpile for weeks now. We've discussed the 18 million ounce level and the 3 million ounce weekly drainage. That fundamental dynamic hasn't changed. If anything, today's price action confirms that the physical squeeze is intensifying, not easing. But Starnovo added a caution that every investor needs to hear. At these elevated price levels, industrial demand might start to wane. That's the risk that bulls don't want to acknowledge. Silver isn't just a monetary metal, it's an industrial input. And industrial consumers have budgets, margins, and alternatives that pure financial buyers don't face. Here's the reality of silver's position in the market. It's tricky. It acts like a haven whenever political and policy turmoil hits. Money flows in seeking safety from currency debasement and geopolitical chaos. But silver is also tied to industrial demand. Solar panels, electronics, electric vehicles, medical devices. All of these applications require silver. And when prices rise too far too fast, that industrial demand can pause, waiting for volatility to pass. That means a smooth rally can easily hit a wall on the demand side. It's happened before in previous silver cycles. It could happen again. And anyone who tells you that silver only goes up from here is not being honest about the mechanics of this market. Having said that, the current setup is unlike anything we've seen in decades. And the supply deficits are structural, not cyclical. The monetary debasement is accelerating, not slowing. And the geopolitical tensions are intensifying in ways that make precious metals more attractive as insurance, not less. Let me give you the context that explains why today's move, as dramatic as it was, might be just the beginning of a larger repricing event. Silver rose 147% in 2025. Let me say that again so it registers. 147% in a single calendar year. That's not a normal bull market. That's a revaluation of what silver is worth in a world where the assumptions of the past 4 decades no longer apply. For most of the modern era, investors could count on certain things. The dollar would maintain its purchasing power. Central banks would act responsibly. Governments would manage their debts. Geopolitical rivals would compete economically rather than militarily. Those assumptions created an environment where precious metals were boring. Nice to have, perhaps, but not essential. Every single one of those assumptions is now being tested. The dollar's purchasing power is eroding at the fastest rate in 40 years. Central banks are trapped between inflation they can't control and debts they can't service at higher rates. Governments are running deficits that would have been considered impossible a decade ago. And geopolitical rivals are positioning for conflicts that financial markets have not priced in. In that environment, a 147% gain in silver starts to look less like a bubble and more like the market finally recognizing reality. The question is how much further that recognition has to go. Scotiabank analysts weighed in today with their assessment. They predict stronger for longer silver prices over the near to medium term. That's institutional validation of the thesis we've been discussing on this channel for months. The supply-demand imbalance isn't going away, the monetary tailwinds aren't reversing, and the price has room to run. Now let's talk about the event that could determine where silver goes from here. The Federal Reserve meeting on January 27th and 28th. The decision and press conference are scheduled for January 28th. That's Wednesday. Less than 48 hours from now, the dollar has already slipped ahead of this meeting. Traders are positioning for the possibility that the Fed signals a more accommodative stance. If that happens, if the Fed hints at rate cuts or even just acknowledges that the economy is weakening, the dollar will fall further. And when the dollar falls, commodities priced in dollars rise. But here's the complexity that most commentators miss. The Fed is trapped. If they cut rates, they risk reigniting inflation that they've spent 2 years trying to suppress. If they hold rates steady or raise them, they risk tipping an already fragile economy into recession. If they signal uncertainty, markets interpret that as weakness. There is no good option. That trap is actually bullish for precious metals, regardless of what the Fed decides. Because what drives gold and silver isn't any specific Fed action. It's the loss of confidence in the Fed's ability to navigate these impossible trade-offs. It's the recognition that the institution that is supposed to manage monetary stability has lost control of the forces it is trying to contain. Kyle Rada's phrase keeps echoing in my mind. A crisis of confidence. That's not just about Trump administration policy, although that's part of it. It's about the entire architecture of the post-World War II financial system, showing cracks that can no longer be papered over. Let me talk about the physical market dynamics, because this is where you see the stress that paper prices don't always reflect. Traders are watching closely for any hint that the tight supply is loosening. Regional price gaps, like the premium Shanghai is paying over London, often shrink fast when supply increases or speculative demand drops off. That's why these premiums matter as signals. When they persist or widen, it tells you that physical metal is genuinely scarce. When they narrow quickly, it might indicate that the panic is passing. Right now, the premiums are persisting. That's significant. It suggests this isn't just a paper-driven speculation event. Industrial buyers and physical stackers are competing for the same limited supply of actual metal. And when you have that kind of fundamental tightness, price corrections tend to be shallow and short-lived. The ETF flows confirm this interpretation. When iShares Silver Trust rises 7.8% in a day, it means substantial capital is flowing into physical-backed vehicles. That capital creates buying pressure on the underlying metal. The trust has to acquire silver to back the shares it issues. That acquisition happens in a market where supply is already constrained. It becomes a self-reinforcing cycle. Higher prices attract more ETF flows. More ETF flows require more physical metal acquisition. More acquisition tightens supply further. Tighter supply supports higher prices. And the cycle continues until something breaks the momentum. What could break the momentum? Several things. A significant dollar rally would make silver more expensive for international buyers. If the Fed surprises with hawkish rhetoric on Wednesday, that could temporarily strengthen the dollar and create selling pressure in precious metals. A resolution of the geopolitical tensions that are driving safe haven demand would reduce the urgency behind precious metals buying. If the tariff situation stabilizes, if the political uncertainty decreases, capital might flow back toward risk assets. A sharp correction in equity markets could create a liquidity event where investors sell everything, including precious metals, to meet margin calls and cover losses elsewhere. We saw this briefly in March 2020 before precious metals resumed their upward trajectory. Or industrial demand could genuinely decline at these elevated price levels. If solar panel manufacturers pause orders, if electronics companies delay production, if the industrial base that consumes silver decides to wait out the volatility, that demand destruction could create downward pressure. But here's my assessment of the probabilities. None of these scenarios seem likely in the immediate term. The dollar is weakening, not strengthening. The geopolitical tensions are intensifying, not resolving. The equity markets are elevated, but not crashing. And industrial demand, while it might pause at the margins, cannot stop entirely because the applications that require silver have no viable substitutes. So while I always want you to understand the risks, the balance of probabilities suggests that the path of least resistance for silver prices remains higher, potentially much higher. Let me address something that I see in the comments frequently. People asking whether they've missed the move, whether $112 silver is too expensive, whether buying now is chasing the top. Here's how I think about that question. If silver is going to $200, which the supply-demand dynamics make increasingly plausible, then $112 isn't expensive. It's actually cheap relative to where we're going. The question isn't the absolute price level. The question is whether the fundamental thesis remains intact. And based on everything I see in the data, the thesis is not only intact, it's strengthening. The deficits are widening. The premiums are persisting. The institutional flows are accelerating. The monetary debasement is continuing. The geopolitical tensions are escalating. When all of those factors point in the same direction, you don't try to time the perfect entry. You establish your position and manage your risk appropriately. That might mean scaling in gradually rather than going all in at one price. It might mean holding physical metal that you don't plan to sell for years rather than trading paper contracts that require constant attention. It might mean accepting that you'll experience volatility along the way because the destination matters more than the journey. Everyone's situation is different. Your risk tolerance, your time horizon, your financial circumstances. I can't tell you what to do, but I can tell you what the data says. And the data says this move is far from over. Let me talk about what to watch over the next 48 hours because the Fed meeting is the key catalyst. The decision itself will be announced Wednesday afternoon. But the press conference afterward is where the real information emerges. Watch for any language about the balance of risks. Watch for hints about future policy direction. Watch for signs of disagreement among Fed members. Most importantly, watch the market reaction. Sometimes the announcement moves markets. Sometimes the press conference reverses the initial move. Sometimes the real response doesn't come until Asian markets open and digest the implications. If the Fed is dovish, expect the dollar to weaken further and precious metals to rally. If the Fed is hawkish, expect a potential short-term pullback that could offer a buying opportunity. If the Fed is ambiguous, expect increased volatility as traders try to interpret the signals. The tariff headlines will also matter this week. Any fresh updates on trade policy could move markets in either direction. We're in an environment where policy uncertainty itself creates demand for precious metals. Even headlines that seem to resolve uncertainty can create new questions that maintain the bid for safe haven assets. Silver trading will probably remain driven by headlines for the time being. That means volatility. That means sharp moves in both directions. That means opportunities for those who are paying attention and risks for those who aren't. Let me give you my framework for thinking about the current environment. We are in the middle innings of a precious metals bull market that started in 2020 and still has years to run. The early innings were the accumulation phase, when prices were low and few people were paying attention. The middle innings are the recognition phase, when prices rise enough to attract mainstream attention and institutional capital begins flowing in earnest. The late innings will be the mania phase, when everyone is talking about gold and silver and prices reach levels that seem impossible from today's perspective. We're in the recognition phase now. The 147% gain in 2025 got everyone's attention. The $112 all-time high today made headlines. But the mania phase hasn't begun. When your taxi driver is giving you silver tips, when CNBC is running 24/7 precious metals coverage, when your neighbors are bragging about their mining stock gains, that's when you know we're approaching the top. We're not there yet, not even close, which means the opportunity is still in front of us, not behind us. Here's what I want you to do right now. First, subscribe to this channel if you haven't already. Hit that notification bell so you never miss an update. The Fed meeting is in less than 48 hours, and I will be covering the reaction in real time. Second, share this video with someone who needs to see it. There are millions of investors who still don't understand what's happening in precious metals. They're watching the same financial television that told them silver would never break $30, then never break $50, then never break $100. Help them find this channel before the next milestone catches them unprepared. Third, leave a comment with your prediction for the Fed meeting. Do you think they'll be hawkish or dovish? How do you think silver will react? I read every comment, and I want to know what this community is expecting. The data I've shared with you tonight is real. The 112.18 high is documented. The 8.5% daily gain happened. The Scotiabank stronger for longer prediction is published. The UBS warning about industrial demand is on the record. The Kyle Rada crisis of confidence quote is verbatim. What's interpretation is where it goes from here. But when a senior market analyst at a major financial firm tells you that silver is surging because of a crisis of confidence in U.S. assets, you should probably listen. When Bullion Vault's Adrian Ash says the main drivers are Trump and Trump, you should probably consider what that means for your portfolio. When Chinese premiums persist above London prices, you should probably recognize what that signals about physical supply. The market is telling us something. It's telling us that the old rules don't apply anymore. It's telling us that the assumptions we've operated under for decades are being revised in real time. It's telling us that hard assets, tangible things that cannot be printed or decreed into existence, are being repriced to reflect their true scarcity. Silver at $112 might seem expensive compared to $25 2 years ago, but it might seem cheap compared to $200 2 years from now. The question is whether you are positioned for where we're going or anchored to where we've been. The Fed meets Wednesday, the dollar is slipping, the premiums are persisting, the institutions are buying, the supply is constrained, and silver just told you everything you need to know with an 8.5% single-day surge to all-time highs. This is Mr. Asian Guy. I'll see you in the next video. Stay sharp, stay positioned. And whatever you do, don't let the mainstream narrative convince you that you've missed the move. The move is just beginning. The crisis of confidence is spreading. And precious metals are the beneficiary of a world that is finally waking up to risks it ignored for far too long. See you Wednesday after the Fed. This is going to be interesting.